Saturday, February 21st, 2026, Maneco 64, home of alternative economics and contrarian views. So it looks like we're pretty much where we left off in 2025 for the precious metals, for gold and silver, and the miners. I always like to look at things from afar, look at the bigger picture. I know sentiment is still a little bit down for the precious metals sector, mainly because we had a big correction at the end of January. But if you look through the numbers, yes, it's very interesting, and that's what we're going to do today. And the other thing I'm going to do is I'm going to reference an article that I saw, a post on LinkedIn by someone called Adam Lockwood, and he put a lot of things into context as well. He looked at gold allocation compared to now and 1980, and it's really interesting, and it kind of segues into what we're seeing so far in the beginning of 2026. And the numbers I'm going to refer to are year to date, until yesterday, Friday, February 20th. So it's always good to do it on a Saturday because markets are closed and nothing's really moving. Before we go into that, just want to talk a little bit about some of the news that's come out yesterday. Big news about the Trump tariffs. Supreme Court voted 6-3 to declare it unconstitutional. They said that only during times of war does the Constitution allow the executive to decide on tariffs. President Trump said he's going to find another way. I'm not sure which other way he will find to keep going. And there's a question of paying back the tariffs, reimbursing American companies that had to pay the tariff, because it's American companies that pay for the tariffs. It's not the foreign exporters, right? They might pay a little bit in terms of how much they can sell their products for to try to make it more attractive, but they don't pay anything, and that would be really it would be messy affair. I think President Trump said that it would be messy. And for me, the big picture on this tariff and Supreme Court situation is, if it holds, if President Trump can't find another way, what it would mean is that the Treasury would be in worse shape fiscally, because it would have to pay hundreds of billions back to these American companies. That would mean a bigger budget deficit, and it would hurt. Yeah, it would hurt the fiscal situation even more. And not that it's great. We're still seeing almost 6% of GDP budget deficit, and it's going to continue according to the Congressional Budget Office, which is a neutral institution. What else happened? Well, the GDP numbers that came out yesterday, I think it was for the fourth quarter, they were expected at 3%. They came out at 1.4%, and that's not good. And that might have something to do with how the NASDAQ has been doing. And why do I say that? Well, because the NASDAQ hasn't been performing that well year to date. And the bulk of the NASDAQ's performance is dependent on the Magnificent Seven, on the AI boom. And also we saw last year as well that GDP in the second, or maybe even the first, but second and third quarter, most of the GDP growth came from AI capex, like into data centers. So it looks like the economy could be keeling over a little bit, and that's not good, right? And maybe that's why President Trump is pushing Iran so much. Maybe that would be a huge distraction. Maybe a war with Iran would rally everyone behind him just before the midterms as the economy slows down. But yeah, on this side of the pond in the UK, Rachel Reeves, our Chancellor of the Exchequer, she finally had some good news. The surplus for January, the budget surplus, was the highest on record, and they started keeping track of it in 1993. A lot of it was to do with capital gains tax. The stock market did well last year, so people had to pay capital gains. January is the month where you have to report, you have to pay your taxes. Like if you report your taxes, if you fill a form, your payment has to be by the end of January. And I guess the other thing that's happening is as things get more expensive as well, and people spend more money, they'll be paying more VAT tax, so the returns increase. So yeah, I think the surplus was 6 billion more than expected. Does that mean everything's fine now in the UK? We don't have a debt problem. We're going to have huge surpluses? No, because in January, that's when you do get the surplus, because people who file for their tax, they have a deadline till the 31st of January to pay the extra amount. So that, that's why it's tax season. So, and I think the reason why it was a record number is because the currency is becoming worth less and less. So it's just the effect of inflation. We saw the GDP here is anemic as well. So yeah, I wouldn't really celebrate too much if I was a bond investor. I would still be highly skeptical of holding gilts. So now let's go to the numbers. And I said in the beginning that gold, silver, and the miners are basically where they left off in 2025, which means they're doing really well. And of course, they outperformed the normal stock market investments like S&P and NASDAQ by a country mile last year. And it looks like it's still the same, despite the fact that silver is corrected from like a high of 121, gold is corrected from a high of 5,600. So let's get to it then, because what I did at the end of last year, I like sometimes writing on paper, we type so much these days. So I've got a list here of all the end of 2025 data and performance for major assets and currencies and so on and so forth. So let's start with gold. So as of yesterday's close, gold is up 18.18% this year. Silver's up 18.13%. So they're neck and neck. So we want to see actually silver start outperforming. And maybe yesterday was a signal that it will. It did very well yesterday, of course, silver. So did gold. So let's jump to the dollar index. Well, the dollar index is down 0.5% year to date. So pretty steady, which means that all you need to do for the major currencies is, even though you should check it each one separately, but it means that the gold and silver are still performing really well versus the pound, the euro, the yen, and so on and so forth, right? So this is not just a dollar debasement theme, it's a fiat currency debasement theme. I've got TLT, which is an ETF that tracks long-term government treasuries, government bonds, and that's actually up 2.58%. So it's done okay, and I'm not surprised because the economy is kind of slowing down. But as you can see, gold and silver is still way ahead of bonds, and I've said that before. It might be steady being in the government bonds, but you're kind of losing out relative to real money, right? Gold and silver. So now to the big boys, to the major indices in the U.S. The Dow Jones is up 3.25%. So yeah, underperforming just like last year, gold and silver. Nasdaq is actually down about 1%. It's down 0.94% to be exact. And funnily enough, the S&P is up 0.94%. So they've canceled each other out, kind of. I know people don't look at it like that. But the thing about the Nasdaq, as I said earlier, it's the Magnificent Seven and the AI boom that's supposed to be driving it. But it seems to be petering out, that AI boom. And I'm not surprised that I'm not surprised GDP was so anemic in the fourth quarter in the US. So that makes sense. Markets always have a way of forecasting things. Yeah, it's funny the way it works, but that's how it works. Well, what about the miners? Well, the GDX, you'd expect the GDX to be outperforming the bullion market a lot more, but it isn't that much really. GDX is up 23.9%, which is a few percentage points higher than gold and silver. So I think there's still a lot of room in the miners as well. GDXJ is a little better, 24.8. Again, I'd expect them to do a lot better than bullion, gold and silver. So yeah, still a lot of room. And SIL, one of the silver miner ETFs, that's up 29.01%, which is a good performance. And SILJ, that's up 30.61%. I think we've had some really good earnings from like Hecla Mining and First Majestic. Those are good companies, and they should continue to do really well, I think. And also the gold miners, I would say. And I had a look at the Bloomberg Commodity Index, because I've been telling you actually for many years that I think we're moving towards hard assets, and that the bull market in bonds and the bear market in yields, which is really good for financial assets, ended in 2020. Yes, we had a big move from 2020 to 2022 in general commodities. It's kind of consolidating, has been consolidating for quite a while now, but we've had a good start to the Bloomberg Commodity Index. It's up 9.1% year to date. So that's where we stand. And I think Joe Public or Joe Blogs here in the UK as well, they're still pretty oblivious to precious metals, to miners, to commodities, and they're still being pushed by advisors or whoever to focus on the general stock market, on bonds, and so on and so forth. And the other thing I would say, though, that could wake people up, especially in the US, is that there was an executive order that was signed into law on August 7th by President Trump last year about making it easier for people who manage 401ks, the investment professionals, to invest in alternative investments like commodities, like gold, silver, miners, and other stuff. And this is supposed to be taking effect, this guidance it is, because it's not that you can't invest in these things, but regulatory wise it's still kind of not clear. But this executive order could pave the way for like around $12 trillion of assets to move into commodities. Part of it, a fraction of it, even if a fraction moves into it, it could be a huge thing. There's a lot of capital there sitting, looking for alternatives. And I I think, yeah, as I said, Joe Public, Joe Blogs, the mainstream financial analysts, mainstream fund managers, they're still heavily allocated towards stocks and bonds. They're not really looking at gold, silver, the miners like we are. But I think that could be changing because last year, again, they missed the boat on gold, silver, and the miners. Yes, the stock market did quite well and bonds were pretty steady, but they missed out on a lot of gains. And I think people are going to start waking up to the hard assets, to gold and silver. And that's why I'm still encouraged for gold and silver, even though the sentiment is still kind of bearish in a way. So I want to look at this post from this guy, Adam Lockwood, on LinkedIn. He wrote something really interesting about a week ago, and it's about gold allocation, and he's comparing gold allocation in 1980 to today. So I'll go through it. It says a lot of talk about gold at the moment, so let's break down what's happening versus historical allocations to the shiny metal. He says we're still in the very early stages of a structural shift toward gold. Yes, maybe not central bank wise and sovereign wealth fund wise, because they're ahead of the game. They've been buying loads of gold and silver, and I'm hearing from my sources that yesterday they bought a lot of gold and silver as well. And he says not because of hype, not because of a price spike, but because of uncertainty. So yeah, that's why he thinks the uncertainty is going to start driving people towards gold even more. He says the discussion now shouldn't be about where gold is going next week. It should be about why capital is quietly migrating from financial assets to tangible certainty. So, and then he goes on to look at 1980 and today. He says it, he calls it the big context. So global GDP in 1980 was 2.9 trillion. Now global GDP, he's got a number of 177 trillion. The reason I say that is because according to the data from the IMF, GDP for the world last year was 117 trillion. But on a purchasing power parity basis, world GDP was 209 trillion. So maybe he's taking a number kind of in between there. So let's say it is 150, 170 trillion world GDP. And financial assets today, he has it at 300 trillion. That as well could be a little more, but it's just a comparison that is important because back in 1980, financial assets outstanding totaled 3 trillion, which is 100 times less than today. That's what he's trying to show you there, the big discrepancy, big gap. U.S. federal debt, public debt, $1 trillion in 1980. Now we rack that up. The U.S. racks that up every 100 days. That took 204 years to get the first trillion. Today, of course, we're near 40 trillion. So he says we've had 100 times expansion in financial assets, yet gold ownership has collapsed as a portfolio allocation. And he says the allocation that nobody talks about. So in the late 1970s, early 1980s, after inflation burned investors, gold allocations were between 6 and 8%. He says they were common, right? Today, let's see what he's found out. Well, research suggests gold represents roughly 0.5% of global financial assets, 0.5%. So he goes on to say, in a word, record sovereign debt, record deficits, weaponized reserves, geopolitical fragmentation, central bank banks buying around 25% of annual mine supply, and yet portfolios are barely exposed. Why this matters, he says. Well, gold isn't moving because retail investors are piling in. ETF holdings are only back to levels seen 5 years ago. There's no mania. This is central bank and sovereign reallocation. And he goes on to say this is a long horizon capital seeking the following: no counterparty risk, we've talked about that, no liability, no default risk, no reliance on a payment system. If you're holding your gold or silver coin, that is payment in your hand. No one needs to pay you anything. Gold provides certainty, he says, about itself, not certainty about its price. In other words, it eliminates permanent impairment risk. In a world where financial assets have expanded 100 times, but gold allocations have collapsed, even a small reversion toward historic norms would imply a very large capital shift. If 0.5% move back toward even 3 and 4% allocation, the scale of repricing required would be enormous relative to available supply. So he says the real question, this isn't about predicting $5,000 or $10,000 gold. It's about the following, he says. What probability do you assign to structural monetary instability? What would the severity of loss be if that risk materialized? And how much insurance does that justify? So where are we now? He says we're not in a trade. We may be in the early innings of a trend. And the allocation data suggests most investors haven't yet recognized it. Wow, I thought that was really good. And looking at the year-to-date data and last year's data, it seems like, gold and silver and the miners are in the bubble. They're overbought. But also reading about this analysis that Adam Lockwood did shows me that we're still in the early innings. And with that, I'm going to wish you all a very good rest of the weekend. Take care. Bye.